Well, good afternoon, everybody. Welcome to the Mining and Metallurgical Society of America webinar. And I'd just like to go over some of the logistics. What we'll do is we will have our presentation, and then we will ask you to either type your questions or comments into the chat box or the Q&A box, and we will address those at the end of the presentation. And I will now turn it over to Betty Gibbs, who will introduce our speaker.
Our webinar today is called Materiality in Regulation SK1300 Technical Reports. And our presenter is Kwame Awuha-Ofe. I think I got it more or less right. And Kwame is at the in Missouri at the university in Rolla, and his bio is in the PR information and also on our website. The slides are posted on the website. And Kwame, I will just turn it over to you and go ahead.
Thank you, Betty. Welcome, everyone, and thank you for taking the time to attend this. Hopefully, I can make this worth your while. As Betty said, I'm a faculty member at Missouri University of Science and Technology, and I was the Mining Engineering Academic Fellow at the SEC during the rulemaking. So hopefully I can shed some light on the rule. Perhaps most of you are aware of this, but I thought I'll start from a bit of a background on the rule. So SEC's rules have been based on Industry Guide 7 until January this year. In fact, we still rely on Guide 7 through this year. And Guide 7 had last been revised in the early 80s, so it's not been updated. And one of the things I've had to discuss with people since this rule was, unless things change significantly, it is unlikely for SK1300 to also be updated anytime soon. We hope it is updated sooner than the 30 years it took to do, or more than 30 years that it took to do Guide 7. But certainly will not be on a 1 or 2 year revision basis. At least that's what I think. There are several aspects of Guide 7 that the industry did not like. For example, its prohibition on disclosure of mineral resources, and also the fact that it did not allow companies to disclose disclose reserves unless those reserves were based on final feasibility studies and a host of things. So industry lobbied really hard for Guide 7 to be updated and replaced with something else. So I was hired into the SEC early 2015, moved to DC and started working in the office in DC mid-January of 2015. We went through various decision points and recommendations, but in the summer of 2016, in June of 16, we actually proposed rules and requested public comments. Then as comments were coming in, there was a change in administration, and so the rule got put on hold for a bit, and then it got picked up again. And we went through addressing the comments and educating the new commissioners, and finally got a rule passed late 2018. The stated purpose of the rule, according to the SEC's final, or the adopting release, as they like to call it, was to modernize the property disclosure requirements for mining companies, to also provide a more comprehensive understanding of a registrant's mining properties. And I think these are important because this is the SEC being on record as to what motivated the rule change, and these set, in my mind, context for the things or the decisions that the SEC made in the rulemaking. So, for example, this last goal here, which was to better align the Commission's disclosure requirements with global standards, which, if you read the both the proposing release and the adopting release, you'll find out that there's a lot of reference to fiscal-based rules. That should signal that the Commission was trying to get as close to the fiscal-based rules as it thought it could. Of course, there are some differences, but generally, it's important to note that the Commission intended to provide more comprehensive disclosure, and that includes the allowance for mineral resources to be disclosed. That is sort of an admission that Guide 7 did not provide a comprehensive overview of the mining properties, but on also the desire to align their rules, the SEC rules, with the global standards meant that you have to do things like pre-feasibility study for reserves and allow resource disclosure. In summary, the rules sought to do three basic things: to rescind Guide 7, to consolidate all of the property disclosure into one standard, because under Guide 7, you found disclosure standards in item 101 of Regulation SK. You found some of it in Industry Guide 7, and sometimes they were even conflicting. So, for example, Guide 7 referred to significant mining properties and not material mining properties, and so SK1300 puts all of the mining property disclosure in one place, and there's a clear standard. At least we thought there was a clear standard for what triggers mining property disclosure in SEC filings, right? And then lastly, to require registrants that have material mining properties. And again, that's the key word here. For some companies that are mainly about mining, it's an easy decision, because clearly if all your business is mining, then mining is material. But for vertically integrated company or diversified companies that hold mining assets, the standard is to ask yourself whether mining is material to the business condition of the company. And if that's the case, then SK1300 type disclosure is required in the annual report. So what is the general framework? And again, I assume that some of you already know this, but I'm trying to get everybody on the same page before we get to the point of today's conversation, which is materiality in the technical report summary. But SK1300 generally requires that if you determine as a registrant, as a company on US exchanges, that mining is material to your business, then two types of disclosure are mandatory: summary disclosure and internal controls disclosure. So if mining is material, except in the case where mining is material and there is only one company, which is a weird case, summary disclosure is required, which covers all of the mining properties. And again, I'm talking about 10K or the 20F, which is the annual report that you file with the SEC. You need to provide in that annual report disclosure concerning an overview of the mining properties as a whole in aggregate. And then you also need to provide internal controls disclosure, which will relate to the mechanisms you use to ensure that your disclosure of exploration results, mineral resources, and mineral reserves are reliable. So those two disclosures are required so long as you determine that mining is material to the business. Then the next cut is to determine whether there are individual mining properties that are material to the company. So it is possible in the case of certain aggregate companies, for example, say, that pick up Vulcan Materials, it is unlikely that any particular property is material to Vulcan, in which case Vulcan Materials does not need to provide any individual property disclosure. However, in cases where there are individual properties that are deemed material to the company, then for each material property, SK1300 also requires that the registrant provide exploration results, mineral resources, mineral reserves for those particular properties. And then there is additional disclosure required. For example, it requires disclosure on reconciliation and production from year to year, for instance. But then the rule also says if you're providing mineral resources and mineral reserves for the first time, then you need to also file a technical report summary as an exhibit to support the disclosure of mineral resources or mineral reserves. Now, if the property is an exploration stage property and you choose to, you can also provide a technical report summary to back up disclosure of exploration results. Now, that is not required, but the registrant has the option to. So that's the broad framework of SK1300, that if mining is material to you, you need to provide summary disclosure and internal controls disclosure. In addition, if there are individual mining properties that are material, then for each material property, you need to provide individual property disclosure for that material, which would include resources and reserves. And if you're providing resource reserve disclosure for the first time, or you are making material changes to the resource reserve disclosure, then you need to attach as an exhibit a technical report summary. And I'll sometimes refer to that as the TRS. So you need to provide a TRS as the attachment. Again, you might be familiar with that, but companies have to comply with this rule for the first fiscal year that begins on or after January 1. So the fiscal year that we are currently in, if you are a December 31st company, then at the end of that period, you would have to provide the disclosure per SK1300. So this image here that I borrowed from something that Greg Gosson at Wood had sent me a while back represents the situation quite well. So, right now we are still in the voluntary filing or voluntary compliance period, where for the fiscal year that just ended, again, this is illustrated for a company that is a calendar year, fiscal year company. For the fiscal year that just ended in 2020, that filing, which people are working on at this moment and beginning to file, that filing was still or could still comply to Guide 7. And then the fiscal year that has just started, the filing for that fiscal year, which would happen sometime in 2022, that filing needs to be compliant with SK1300, because there's some questions as to what registration statements ought to look like. The SEC recently issued some guidance to say that if you have registration statements this year that rely on your disclosures in the previous year, then they don't have to be SK1300 compliant. But presumably for new companies that don't have Industry Guide 7 disclosures to rely upon, then they would have to provide SK1300 disclosures with their registration statements. So that's a bit about the general framework and the background to the rules, so we can get into the discussion for the day. And before we do that, we need to also ask about the TRS itself. What are the TRS requirements? As I've already said, the rule says that if you're disclosing mineral reserves or mineral resources for the first time, or you're making material changes to your resource or reserve disclosure, then you need to provide a TRS as an exhibit. So it's important to know that there's the annual report itself, which is the company's disclosure document. And then as an attachment to the annual report, a qualified person or qualified persons would prepare a TRS that the company attaches to its annual report. And of course, as I've already said, if it's exploration results, the company can choose to file a TRS. Now, it's important to note that if the property is exploration stage property and you choose to file a TRS, then every time you make material changes to the exploration results, you have to update the TRS. In other words, you cannot use the TRS to back up exploration results disclosure, and then when there are material changes to the exploration results, elect not to do that. So that's something people ought to think through before they make the decision to use a TRS on an exploration stage property. Then if you go to section 601 of regulation SK1300, not SK of regulation SK, where all exhibits, not just mining exhibits, where all exhibits are described. It also provides, we added in two Section 601 requirements for the format of the TRS. So there are 25 sections to the TRS. These are the first 16 sections. I'll show the next sections in the next slide. But if you're familiar with 43101, you'll begin to see some very similar trends. And being the guy who originated the document, I can tell you that the starting point was a copy and paste from 43101, and then we started working from there. So it's no surprise that it's very similar to 43101. And then the last few sections, starting from section 17, go through all the way to section 25. So these are the required sections of the TRS. And each of these sections, there are requirements under the rules. So if I may quickly show example, if I go to 601 and say go to property description, there's requirements under property description for what a QP should put in the property description. So each of these sections has specific requirements for the section, but that's not the point of today's conversation. The point of today's conversation is if you look at the regulation in under 601B96 trade B, it does say that when a QP is working on a TRS, the QP should include the information requested of the TRS to the extent that it is material. So it's important to know that the rule does not require a QP to put everything in, even if the things that are being included are deemed immaterial, or that investors will not provide them, attach importance to those disclosure items. And so it raises the question, well, how do QPs determine what is material and what is not material under SK1300? And I think that's what I'm hoping we can shed some light on, and then we can have some conversation around that idea. Okay. So first off, the SEC standard definition of materiality is what I'm quoting here. And if you're familiar with the SEC, this should not be news. This is not the SK1300 definition of materiality. This is the standard SEC definition of materiality. The commission, or this definition, the second bullet point, this definition is also this stems from the Supreme Court's definition of materiality, which says that given the total mix of information, a particular item is material if a reasonable investor would attach importance to that item in evaluation of it. So modifying it for property disclosure, one would then say that if there's information about a property, that given the total mix of information in the disclosure, a reasonable investor would attach importance to it in evaluating the property, then we would have to deem the information material. It is important to note that if you read the rule says that the SEC already considers certain things to be material, and therefore those are required by the rule to be disclosed, and QPs do not have much discretion about that. So a good example being commodity prices. Over and over in the release, commodity prices are said to be material, and that QPs should disclose commodity prices. Secondly, this rule included a standard for qualified persons for a reason. Guide 7 had no requirement for qualified persons. And there were several reasons. This is the global standard. Remember, the SEC's intent to align US standards with global standards. And also, the commission believed that requiring a QP standard and requiring QPs to sign off on the disclosures was going to be better for investor protection, right? Now, the side effect of that is that QPs are going to be treated as experts under US security laws, which would mean that QPs are liable for material misstatements or material omissions in disclosure that they provide. And so it is important as we think about materiality is if you're going to get in trouble for writing a TRS, chances are that you're going to get in trouble for omitting something that is material or misstating a fact that is deemed to be material. And of course, the tricky part is it would always be litigated in hindsight. After the fact, someone would say this fact was material and it wasn't in the TRS. And yet when you are writing the TRS, you are going to have to look forward and say, what would a reasonable investor attach importance to in determining what is material and therefore should be in a TRS. So this is the crux of the matter. My big guidance would be, the big guiding principle here is to look at materiality from the investor standpoint, right? The investor wants to invest in company X. Since the property you're working on, and presumably the only reason you're providing a TRS is that the company believes that that property is material to investors and it's material to its business condition, that's why we need a TRS. Then it stands to reason that things that are important to evaluate the success of that material would be material to the investor. If the investor wants to invest in company X and property Y is material to company X, then information that speaks to the success of that project should be material to the investor. Consequently, you should be looking at the project and asking yourself, what are the items that speak to are material in discussions of whether this project will be successful or not, and whether the project is likely to produce the value to the company that one expects it to produce or one is putting in the TRS. And so that's the overarching guidance I would give. The reality is how you apply that to particular cases is always going to be difficult. And I don't think I'm setting off today to say I can answer every question and clarify every bit of ambiguity in the rule. But hopefully I can provide some guidance, broad guidance that you can use as guiding principles when you're making decisions on what to include and what not to include in a TRS. And I'm saying that link between the success of the business and the success of the project, which is deemed material, is what should guide your discussions. So by necessity, QPs should apply this to each section of the TRS because you're going to look at each section. You're going to look at the SEC requirements like I just showed in section 601, and you're going to write that section, and you're going to have to ask yourself, what is material in this section and what is not material, right? And what is material would also depend on the particular facts and circumstances, the particular project, the particular commodity, the particular company. And so it's important to not use the template from the last project without thinking through, are these items important for this particular project? On one project, tailings might require a lot of attention, whereas in another project, maybe not as much. In one project, you might find that I need to spend a lot of time talking about community engagement and how permitting can be risky, whereas in another environment, maybe permitting is a straightforward exercise for that particular project. Needless to say, the broad principle I'm providing here is to be mindful of the big guiding principle and look at it on a case-by-case basis and make decisions on a section-by-section basis on which pieces of information should go in. Again, remembering that there are certain items that you really don't have much choice because the rule itself attached importance to those items, and therefore those need to be provided. And this principle that not everything needs to be discussed, I'm going to use market studies to illustrate it. And so this quote here is just the beginning of a broader quote from the release. The adopting release, the final release, we wrote the statement in there which I think illustrates the whole point. So even though the TRS requires a section on market studies, if you read through the release, you come across this statement where the SEC is essentially saying, well, the market statement might be required in certain cases, but not in all cases. And then it goes on to say, specifically, if the commodities are traded on an exchange and there's an established market for the product, then maybe market studies are not necessary. But in other cases, market studies will be necessary. But then even when market studies are necessary, the rule then goes on, or the release goes on to say, the rules do not require the disclosure of all details of the market study, but only those details that are material to investors. So I use this quote to illustrate the point that when we were writing the release and the discussions within the commission, clearly the commission understood that not every item in the TRS is required for every project and every TRS, that QPs are going to have to make choices on what is material and what is not material, and what needs to be in the TRS and what does not need to be in the TRS. And that's going to be the part where QPs like you are going to have to engage with the process and try to understand the rule and provide a disclosure that is important to investors. Because it is important to understand that the SEC wants this to be focused on investors, not on mining, nerds like you and I who want to understand every bit of detail of the project. This document is for the purposes of investors and needs to be focused on what is material to investors. So hopefully I've been able to provide a broad enough guidance, and we can discuss some items and have discussions around this concept. But I would end by saying the big takeaways that I was hoping you take away from this is that SK1300 TRS requirements require QPs to include material information. Now, we could talk about how things would evolve and how much one might end up with immaterial information in the TRSs. I would say that off the bat, SEC is intending to keep the TRSs short and not have it bloated with unnecessary information. But the intent is certainly that material information should not be missing from the TRS. Secondly, it's important to recognize that QPs will carry liability if they omit material information or make misstatements about material information. And it is important for QPs, if you intend to serve as a QP, to educate yourself, to read the rules. I've often said, to really understand the rule, it's not enough to read the regulation itself. It's important to read the proposing release and the adopting release. And I know it's daunting, but I get a lot of questions, and I even know that the SEC is beginning to say that few cases they have seen of TRSs, it seems people have not read the rule. And I think it's important to really read the releases and the explanation of the different concepts to understand the rule. Of course, the other thing you could do is that I know there are others providing short courses there, and I'm doing short courses myself on the rule where we get through. And the next one is this month. So if anyone is interested, check it out. And we do spend a lot of time trying to break down the rule and answer questions as we go along. So with that, I will stop my prepared remarks here, and hopefully we can have some dialogue around the principle of materiality in the TRS.
Okay, Kwame, I would like to start with a question myself about materiality. We do have a couple of questions coming in. One of the sections is geology and another is infrastructure. And in an initial report, you would put in information about the geology and infrastructure and some things that don't change very much. In subsequent reports, would you repeat that, or would you just refer to the previous report?
I would personally, every time you have to update the TRS, even things that are not, that have not changed, I would I would redo it. In a sense, even if I have to repeat the same bit of information, repeat it. Because remember that you don't have to file a TRS every year. You only have to file TRSs when there are material changes to the TRS. And when you do that, technically, it is as if the new TRS, the current TRS, is the only one that matters. The expectation is not for investors to have to go through the current TRS and look at the one that was filed 5 years ago and try to piece it together to find out what the full story is. That if you say this is the TRS we are currently relying on for our disclosure, that an investor could go to that TRS and find the information they need.
Okay, thanks. That's kind of what I thought, but I appreciate that. We do have a question from Craig Waldy, and he says, do you have an idea how many technical report summaries have been filed so far on EDGAR?
I don't have a number. I know there are few. I have reviewed one of them, as in just not that reviewed it in any technical capacity, but I found one. I think that's by, what's the name of the company? It's not a mining company, but they bought a mine and there's a registration statement out there. I can find it for you. I'm not aware of many. I would say probably the number is less than 10, but the one problem we have right now is there's no easy way to search for Exhibit 96, because remember, until this rule change, Exhibit 96 was a placeholder exhibit number. If I could go back to the rule text and show something. So if you go all the way back up, you would see that when you get here, 97 to 98 is reserved. It used to be that 96 to 98 is reserved. So there are a lot of companies that are still putting exhibits that have nothing to do with mining in 96 because they don't know yet that, and if you are not a mining company, it's unlikely that you will know for a while that 96 is now reserved for mining disclosure. And so if you search for Exhibit 96, you're tending to pick up, at least when I do, I'm tending to pick up a lot of disclosures that have nothing to do with mining. That's what makes it challenging to isolate TRSs that are outstanding. I personally haven't found an easy way to search in EDGAR for mining related Exhibit 96. And it's kind of painstaking to find them. So yeah, Hycroft mining, thank you. Somebody put that. That's the one I have reviewed. So I don't know, it's a long about question to say I don't know exactly, but there are a few out there.
Okay, our next question is from Doug Silver, and he says, over half of the public mineral companies are Canadian domiciled, and the Canadian regulators have spent a lot of time interacting with this large group of companies to align the investor and mining company interests. So what parts of NI 43101 did you not include in SK1300?
Just in the TRS or all of the rule? I mean, all of the rules take a while to discuss the differences. As far as, so maybe, Doug, if you want to clarify it a bit for me, it will help. Are you talking about just the TRS or the entire rule?
It's just the TRS.
Okay, just the TRS. Okay, so the TRS is pretty similar, except for certain sections have been collapsed. So for example, if I could go back to it, for example, under 43101, these sections, exploration is split into, I believe, exploration and drilling, but under SK1300, that is combined into one. And I could explain the conversations that went on and how the SEC feels this way. I think it's important, and I maybe I hear that in the comment. It is important to know that, one, this is not Kwame's rule, or is it Ken and John, the other two mining engineers in the SEC, this is not our rule. There's plenty in the rule that we disagree with. In the end, there were 3 people for the proposal release and 5 people at the time we passed the rule who have been approved by the Senate to pass a rule on behalf of the SEC. And in the end, it's what those people would vote for that mattered. In the end, while 43101 and the SME guide and all these things existed, we were always asked the question, we get that, but why is this the right thing to do for the SEC? And when the commission did not feel that that was the right thing to do, they weren't going to do it just because that's what the Canadians have done. I would tell you, for example, it took a lot of arguing to get the price requirement to be the same as what you have in 43101. What seemed obvious to me that that's the global standard was not obvious to the commission. And we had to have meeting after meeting to tell the commission that the industry will police itself if you allow them to use prices and have to justify them. It would not lead to, there would be bad actors. There are bad actors, and the SEC is worried about bad actors. But so anyway, a long answer, but the short answer is, in the TRS, I believe most of the things are there. It's just that things are combined. The other difference that I think is really important to notice, under 43101, 43101 allows the QP what is called limited disclaimer of liability. SK1300 does not allow the QP to disclaim any liability. Under SK1300, there's a provision that says the QP could disclaim information that is provided by the registrant. So that's what should go in the section 25. So there are certain items, and they are not broad, but there are certain items, for example, macroeconomic conditions you can obtain from the company, permitting opinions or legal opinions about permits you can obtain from the registrant. So there are a few items that if you obtain from the company, the QP can disclaim that information. So while limited liability as known under SK 1300 does not exist, and as known under 43101 does not exist, under SK 1300 item 1302, you can find certain information that if you receive them from the company, you can disclaim them and the company can be liable.
Okay, we have a different question from Don Garcia. You mentioned
I can't hear you. Let's see. So,
oh, sorry. I'll start again. You mentioned the environmental disclosure. CIM is trying to develop a guidance regarding what are standard or best practices related to environmental. Is there any sort of guidance on environmental or social issues that SEC recommends?
yeah, that's it. So unfortunately, the SEC is not going to be like the Canadian regulators that shows up at conferences and engages a lot. Where we would find what the SEC is thinking about is occasionally we'll get the CDI, the guidance, for example, the one they issued recently on registration statements. But more importantly, we are all going to have to stay tuned once people start filing SK 1300 TRSs and the SEC issues comments. So one of the things that's different between the Canadian regulators and SEC is Congress has mandated the SEC to review every company's disclosure at least once every 3 years. And they are going to do that. I have seen the spreadsheet. The engineers have a spreadsheet, a rolling spreadsheet that nobody knows, but it has every company on a schedule, and your report is going to be reviewed at least once every 3 years. When they do those reviews, they issue comments. Those comments are available publicly through EDGAR. So we are going to have to stay tuned and learn as practice evolves as these comments come out. Those would be the best way to learn. But at this point, beside the documents that are out, the 2 releases and the regulation itself, there is no additional guidance than the text of the law, which tells you what should be in And of course, then it also says to the extent that they are material.
All right. That sounds pretty heavy, having to go through all the companies every 3 years. Ought to be able to hire a lot of mining engineers for that, I reckon.
Well, they are currently doing it. We just don't know, but that's what they do now. They go through all the mining companies every 3 years.
Wow.
Yeah,
Okay.
that's what John and Ken do. They're 24/7. That's their job. They just
Yeah.
look at BHP and then put it down, and then go to Rio Tinto, and then go to Freeport, and go on and on. That's what they do.
Uh-huh. Okay, Mark Bowron asks, is there a threshold for materiality in terms of percent of book value or another corporate financial metric? For example, is 1% material?
Okay, so again, Mark, I'm not sure that this question seems to be a question about materiality to disclose under SK1300, right? Because
Right.
if we are talking about TRS, then the assumption is if your company is preparing a TRS, then it assumes that that property is already material. So if you're writing a TRS as a QP, then I would assume that somebody has made a determination that the property is material. And I'm not sure whether the question is about how to determine whether the company should provide SK1300 disclosure, or how a company discloses or decides whether a particular property is material. Needless to say, in the proposing release, we had proposed that 10% be a presumption of materiality. We began to realize based on comment that even though we were intending 10% to only be a presumption, and that presumption could be rebutted by other evidence, people were interpreting the 10% of asset, that's what we had proposed, as a bright line test to say if the property is more than 10% of the asset value, then it is material. So in the final release, we struck that out. And the rule just says you should consider all quantitative and qualitative factors in determining whether a property is material or not. And so one of the quantitative items would be revenue and asset value. Those are actually listed in the release, that the revenues and the assets and expenditures, all those things could be quantitative. But there are also qualitative factors, like, is management saying this property is strategic to our future growth? Is that particular mine of such a unique nature that it's an important part of the company's portfolio? So regardless of whether asset value is high or not, if a particular mine is of strategic importance, that will make it material. So hopefully I've answered the question. There is no bright line test that should be used as the measure of what is material and what is not.
Okay, do have another, before I get to the next question, there's another comment from Doug Silver. He says, there aren't that many U.S. mining companies. Most mineral companies listed in the U.S. are either cross-listed from Canada and enjoy 43101 reciprocity, or very small companies on the pink sheet that hardly ever trade. So Craig Waldy is a lot busier than the SEC.
Possibly. I mean, possibly. And Craig, thank you for that. If the company is a 40F filer, and the 40F is what Craig is referring to, which would mean that they're a Canadian company that meets the multi-jurisdictional disclosure system standards, therefore they can file their 43101 filings in Canada and just put the 40F form on top of it and meet US requirements. Even those companies don't get reviewed. The SEC still reviews 40F filers and can issue comments if they so choose to. But I think your point is well taken, that it's not the same as the level of review that the Canadians have to do, because they don't have as many companies.
Okay, we have a question from Marco Carrasco. In the case of cement companies, which are now included in the reports under the new rules, The limestone quarries that are the main source of raw materials will be included in the reports. But what about the properties of other additional materials such as days, sands, which are used in smaller quantities? Should they be reported with the rigorousness of major materials?
Yeah, that's a good point. So we did discuss this, and the SEC's view is that if you're going to use the term reserves, it means the same thing, and resources mean the same thing. So you cannot define reserve or resource differently just because it's clay or it's sand or it's gold or copper, right? So the same principles of what qualifies as a resource or a reserve is the same. The question then in my mind, and correct me if I'm misunderstanding your question, is should the clay mines and the sand mines be deemed material? Because if they are not material, then you may report the resources and reserves for the clay mines as part of your summary disclosure, but there is no need for the detailed individual property disclosure, and certainly there is no need for a TRS, because remember, TRSs are limited only to properties that are deemed material. Could there be a situation where a cement manufacturer has a clay mine or a sand mine that is deemed material? Possibly, because maybe that clay mine, for whatever reason, is so important to its cement production activities that it is deemed material. But it is unlikely that such small mines, especially if the clay or sand could be bought easily locally, may not be deemed material. But that's a discussion for you and your attorneys to figure out whether the smaller properties become material or not. But if they are deemed material, then the same level of reporting would happen because of the materiality more so than because of whether they are clay or sand.
Okay, Marco has a follow-up question. In the chapter on sample preparation, analysis, and security, international best practices are used. My question is, the SEC reporting with new rules consider the mandatory use of an independent laboratory for the estimation of resources and reserves?
So again, I'm not sure what the standard for independent laboratory that you are referring to, but the standards under the preparation and data verification really do not mandate anything but put the liability on the QP to provide an opinion as to whether the data is adequate to do what it is that you are doing. So if it's an exploration result disclosure or resource disclosure or reserve disclosure, the QP is going to have to be on record as stating, I've looked at the QCQA, I've looked at the security and the data controls and all those things, and I think the data is of such quality that it can be used for resource estimation or reserve estimation. And of course, that puts the liability on the QP for having to do that. There are a few things that are specified as yes or no. So for example, you cannot use assaying methods that have never been demonstrated to be viable or been used for commercial use to disclose resources under SEC rules. But other than that, the responsibilities actually put on the QP to be the one making a determination and disclosing that opinion as to whether the data is of such quality to be suitable for the work that he or she is doing.
Okay, we have a question from Keith Leskowski. If Company A has a property and prepared a TRS on the property, then Company A sells the property to Company B. Does Company B have to prepare a new TRS, or is the TRS transferable?
Well, if it is a material property, you are also supposed to receive a consent. So if the consent is not transferable, which I doubt that unless you bought the company and the guy still works for the company, that's why you might have to reissue the TRS, because you don't have the consent to use it to support your disclosure for Company B. The other thing that also comes into place here is, unlike 43-101, SK1300 allows consulting companies, so third-party companies, to sign on behalf of their employees, which should presumably make it easy to go to, say, company A hired consulting company C, and so once company B bought the asset, perhaps they could easily go to consulting company, whether or not employees have moved on, to get that consulting company to give them consent. So I can see that perhaps changing a little bit, but TRS cannot be passed on because the company providing the disclosure needs the consent of the QP. Even in the cases, so unlike 43101, not all consents have to be filed, but even when the consent should not be filed, the rule says the company should keep that consent for as long as it relies on the TRS. So my interpretation would be that you can't just take over the TRS when you don't have the consent to use it.
Okay, so Mark Bowron makes a comment. So the company decides materiality.
For a property, yes.
Yeah.
Again, it's really important. I find that when I talk to mining professionals, we are trying to do too much. It is only the TRS that is your document. The companies are not reported, is none of your business. It's management's business, right? Management decides whether they should comply with SK1300 or not. They have to make the determination. Of course, they would ask employees, mine managers, and all that, your opinions, but it is the company's business to determine whether a property is material or not. It is the company's business to even determine whether they should comply with SK1300 or not. But the TRS, since you are the one signing it, it's your document. And it is important to distinguish between the two, that you are liable for the TRS. You are not necessarily. Now, also, the company should quote your TRS accurately when it includes it in the annual report. But we shouldn't be worrying too much about whether or not the determination of what is material is accurate or not. I'm working with some companies, and it seems to be an issue that, I've even just last week, I was working with a company, and one of the, we were having conversation on how they were deciding material properties. And it was pretty obvious that a particular property is not material, but someone from that site on the call was worried that if they don't say it's material, then the community is going to be upset. And I found that argument interesting, that the company was trying to impose extra regulatory burden on itself just to please the local community. Those are discussions that management should be making, and not individual QPs.
We have another comment from Craig Waldy. There are always more mining companies to review than time in the day.
I would agree with that.
Yeah, right. Okay, we have a question from Yusuf Dafi. What precision can we attribute to each category of resources or reserves? Knowing that based on geostatistics, we can calculate the precision of the estimate, but the standards give the PQ, the qualified person, the possibility of categorization, which implies this criterion is not auditable. QP, please. Yes.
I'll do my best to see if I answer the question, and please come back if I have not answered the question right. So in the proposing release, we had articulated the QP has to provide a plus or minus and confidence interval estimate around the classes. We walked back that. So if that's what is bringing the confusion, we walked that back in the final release and said QPs don't have to do that. But even then, and in both cases, we indicated that reliance exclusively on geostatistical confidence intervals is flawed, because those confidence intervals do not account for things like quality control and other things that are outside of the estimate of, say, a Kriging invariance or estimate of simulation confidence intervals. And so the commission is probably clear and is on record saying that if you are going to rely on confidence intervals from simulation or ordinary Kriging or whatever, that you need to look broader than just that estimate, because your confidence interval presumably is bigger than just what the software reported, because your risks are broader than just the estimate you can. So first off, I want to say we walked back that requirement that you have to provide a plus or minus 95% whatever confidence interval. It's not a requirement anymore. And if you are going to do that, you are going to have to be mindful of the fact that the commission has signaled, and I believe it's actually in the rule. I could look it up quickly, but I believe it's actually in the rule that if you use confidence intervals, you should account for extra. Yeah. So I don't know if everybody sees my screen here. This is the relevant text. If the qualified person chooses to use confidence limits estimates from geostatistics, he or she should consider the limitations of these methods and adjust the estimates appropriately to reflect sources of uncertainty that are not accounted by these methods. I hope I answered the question you were asking.
He also says the idea is how to quantify these intervals and why it is not standardized.
Well, it's not standard. If you knew a way to standardize, I would have loved to know that when I were writing the rule. I don't think it's easy to standardize. That's because mining disclosure and mines differ from high negative effect things to limestone to coal, and it's really difficult to standardize. And we didn't want to put forth a standard that disadvantages certain companies and makes it difficult for people to raise capital on the stock market.
Okay, that's Kwame. That's all the questions that we have. And we appreciate all of your work putting this together and your obvious experience with all of this. So if there are no other questions, do you have any final comments?
Yeah, thank you. These have been very good questions. I've enjoyed the conversation. I would encourage all of you, please read the rule. And I know it's a lot of reading, and perhaps the best way then is to enjoy, go to short courses, listen to webinars like this and educate yourself. There's a lot in there, and hopefully all of us will learn a lot as the comments start coming out. I myself have been asked questions since I left the commission, and sometimes I've gone, we actually never thought about that. And so there will be things that come up that the staff would have to interpret. So we would have to see how they do it, and we'll have to stay tuned and just stay on top of this as practice evolves, hopefully till we get to some sort of steady state.
All right, well, I think that we're done. Susan, do you want to have final comments?
Just that the slides and the recorded session will be available on our website. And that's about it. So thanks to everybody for participating.
Yep. Thank you all.